My name is Jaron Elter. I am the Agreement Compliance Audit Manager at WSDOT. And so I'm here to talk a little bit about indirect cost rates and the Safe Harbor program. So before we get too in deep with the presentation, I'll talk a little bit about the Internal Audit Office. We have different teams that cover different aspects of the agency. We have an internal audit team that makes sure that our agency is following the laws and regulations and procedures that are set forth for us. We have an internal investigator that looks into like fraud allegations or like if we have stolen equipment, that kind of thing. We have a tolling auditor who is specifically assigned to the ferries and to our tolling vendors who manage our hot lanes and our bridge tolling. And we also have a team that is designated for indirect cost rate reviews and agreement compliance audits. And we also manage the Safe Harbor program. Next slide, please. So when we're talking about architectural and engineering agreements, most of them are federally funded, and that means there are federal rules that follow that federal funding. So when we have A&E agreements that we're letting out to the public, those rules, those federal rules require that it's a qualifications-based selection process for the consultant. So we don't necessarily have the lowest bidder designing and building our bridges and overpasses, which I think everybody can appreciate. The flip side to that is that there is the federal acquisition regulations, which kind of help control costs and make sure that the public is protected from unreasonable expenditures. And so when you, next slide, please. So when you're getting your billing rate approved for the agreement, there's actually 3 different rates that you're gonna get approved, and you're gonna be working with multiple offices. So there's the direct labor rate. Those are approved by our contract services office. There's the indirect cost rate or your overhead rate, which is reviewed by the internal audit office. And then there's also a fixed fee or profit percentage, which is negotiated with our contract services office. Next slide, please. So when we're talking about your billing rate, there's, like I said, there's 3 different elements. And so you have, when you're billing, each employee is going to have their own billing rate based on what their actual hourly pay is. And then you're going to have your overhead or indirect cost rate. That's going to be based on whatever you're paying that employee. And then you have your fixed fee. And so those are just percentages of that raw labor rate. So in the example, if somebody is in the Safe Harbor program, they're going to have an approved overhead rate of 120%. They would charge 120% of the $45. They would also charge the 30% fixed fee on that $45, giving you a total billing rate of 112. So when we're talking about the different rates, just kind of keep in mind that there's, while you have 3 different elements, you know, you also have the fixed fee there. So a lot of times people get fixated on the indirect cost rate and they kind of forget that there's an additional part to it. Next slide, please. So when you submit for an indirect cost rate to get approval, you have different options. There's the cognizant review, which WSDOT only performs like 3, so it's not really an option if you're taking this class. You do have the option for a CPA report. It's not a requirement unless you have over $1 million in invoices to WSDOT. You're also free to prepare a schedule yourself and then submit that for a desk review. And if you're not able to do that, then there's the Safe Harbor program, which gives you a chance to work on the project while building your accounting system for compliance. Next slide. So when we talk about compliance with the federal acquisition regulations, we're talking about tracking your expenses that you incur on your projects to those actual projects in your accounting system so that you can differentiate your direct project costs from your general overhead costs. It also means tracking your general overhead costs in a way that if you have anything that is not allowed to be reimbursed through your overhead rate, you can pull that out. And so the safe harbor program is available for firms that do not have their accounting system set up for FAR compliance. If you have never worked on a government project, I wouldn't expect you to be FAR compliant, because even though it's based on the standard cost accounting, there's a niche in your general overhead and what's considered allowable and not, right? So that wouldn't be standard cost accounting. That's where the specialty comes in for the FAR. The safe harbor program will give you a default indirect cost rate that you can use for 3 years when you first sign up for the program. So it gives you time to work on the project, and you can see whether or not it's going to be worth your time to invest in updating your accounting system. Next slide, please. So, we have these are basically the 5 basic steps in becoming FAR compliant: setting up your standard timesheets and timekeeping policies and practices. You need to make sure that you're tracking all of your hours worked. So even your salaried employees need to be tracking all of their hours worked. You need to track have your chart of accounts set up to display your direct cost expenses. So that means having your cost of services sold section in your chart of accounts set up. A lot of times, small firms, they don't have that section. So that's something that you want to add if you don't have that. And then segregating unallowable costs. So that's going through your indirect costs and identifying anything that you need to back out on your indirect cost rate schedule. Developing your policies and procedures. Not every expense that a firm could have is going to be addressed in the federal acquisition regulations or the FAR. So it helps to have policies that show why you're incurring expenses and how you're treating them, so that you can establish it as a reasonable business expense that can go to supporting an expense as reimbursable. So it's always good to have strong policies. And then once you have a full fiscal year worth of data, then you can submit that for a indirect cost rate review. So this is an indirect cost rate schedule. This is what you want to design your accounting system to be able to provide. Like I said, we start with your direct labor. So you need to identify all of your direct labor that you incur on your specific contracts. And then there's the fringe benefits section and your general overhead section. All of those numbers will come from your profit and loss statement in the financial statement amount column. The adjustment column is to back out any expenses you incurred during the year that you're not allowed to be reimbursed for. So like an example would be advertising. That is something where, you may be able to get business from a billboard or through some kind of ad in a A&E magazine or something like that, but that's not how you're going to get work with WSDOT. So, the federal government doesn't go to your website. They have the bid and proposal process. So they don't reimburse for advertising expenses, but they do reimburse for bid and proposal expenses. And so once you back out any expenses you have that you're not allowed to be reimbursed for, we divide that by your direct labor to get your actual indirect cost rate. Next slide, please. So, like I said, you have different options on submitting for an indirect cost rate review. If you submit submit a firm prepared schedule that you compile yourself, these are the documents that we would ask for as the supporting documentation, so that we can double check check the numbers, right? So we ask for your financial statements, your profit and loss, and your balance sheet, a payroll summary, a labor distribution report, which supports the split between the direct and indirect labor. And they're really, that can be as difficult or as hard or easy as you make it, right? It really just depends on how you put your forethought into setting up your chart of accounts in your accounting system to provide the information. Next slide, please. So some of the frequent questions we get about the Safe Harbor program, who's eligible? So anybody is eligible as long as they haven't had a FAR compliant, or they haven't certified to having a FAR compliant indirect cost rate before with another DOT, right? So it's not, there's no DBE requirements or anything like that. Like I mentioned, you get approved for the default safe harbor rates for 3 years, but you're not stuck with that for 3 years. So if the 120% that safe harbor is using, if that is low, you can absolutely submit as soon as you can provide the information for supporting your own rate based on your actual expenses. Is an audit required for to graduate from safe harbor? This is a big one. WSDOT does not require an audit until you have over $1 million in invoices in a given year, right? So a lot of times people will ask you, like prime consultants, local agency project managers, even our project managers will ask you if you've had an audited rate, right? So people get confused and they think that if our office has looked at a document, it's been audited. That's not really what that means. And so people misuse the term audit all the time, right? What they're asking is if you have an approved rate, right? So you just want to make sure that you get an approved rate by submitting for an indirect cost rate review. Next slide, please. So the difference between an indirect cost rate audit and a desk review is actually quite a lot. So in an audit, you have, typically you're going to have a CPA come in and they're going to perform testing to confirm that the transactions happened, that the accounting was correct, and they're going to do a lot of testing. For us in our desk reviews, we do very high level testing, right? So we might, like I mentioned, we might confirm that your payroll report actually supports the numbers on your profit and loss statement, right? That's that's just a very basic test. And we don't offer assurance to other people saying that they can trust our approval as you know, with any kind of assurance. Whereas a CPA audit, they do put an opinion on it and they do actually add that level of assurance. Next slide, please. So when it comes to preparing for an indirect cost rate review, you really want to plan ahead because you're looking at, when you're submitting, you're submitting a closed fiscal year and it's your most recently closed fiscal year. So if you're in the Safe Harbor program now and your rate expires in 2025, hopefully you started this year with a chart of accounts ready to track your expenses as direct and indirect, allowable or unallowable. And so that as you finish the year, you've already done all of the hard work. And then at the end of the year, you close out your books and the information is readily available for you. If you wait until the day before your safe harbor letter expires and you call us up and ask us what you need to do, we're going to tell you need to build a time machine and go back a year and plan for your indirect cost rate review. You want to make sure that your chart of accounts is ready to go before you start the year you're going to use to graduate from the program. One of the biggest challenges firms have is labor reconciliations. A lot of times their documents that they provide us for the indirect cost rate review do not agree on the labor expenses that they had during the year. So we recommend performing monthly labor reconciliations just to avoid that at the end of the year. If there is any kind of a transaction that doesn't flow right in your accounting system, it's much easier to catch it when you're looking at a month versus a year. You also want to consult our website. We have a ton of information and training on our website. Next slide, please. In fact, we have interpretive guidance documents. Those are for expenses that we've had a lot of questions. There's some there could be some gray areas on what's allowable and what isn't. We also have training videos on the components of an indirect cost rate schedule, where those numbers come from and how to put it together. And then we also have a ton of forms, templates and examples so that you can see what we kind of expect your documents to look like. Next slide, please. We have our contact information here, and I think that's actually all I have for my presentation. So do we have any questions?
Nothing in the chat.
Okay.
Yeah.
Questions in there? We needed to give them some coffee back.
Yeah.
Go ahead.
I had a quick question about the labor reconciliations.
Okay.
Is there any specific threshold or like guidance around that, what that could look like, or what's the best way to do that?
So we have an example on our website. I would recommend taking a look at that, right? Because what you want to do is, what we do is we start with your payroll report and we back out any payments that were not based on hours worked, right? So like if your bonus is in that amount, or if you had like back pay or, you know, reimbursement or something like that, you take that stuff out of it. And then you have a staff utilization report, which reports the hours that people worked and the dollar amount that time was worth, right? And so hopefully, when you take out the stuff that wasn't based on hours, your payroll will equal what your staff utilization report shows. And then hopefully that amount that your staff utilization report shows will be reflected in your profit and loss statement.
Perfect, thank you.
And when you think about payroll report, I mean, what are you using? Is it a master control? Is it a prepared from their internal system?
It really depends on who we're working with. You know, some firms like to use a third party. So like ADP will give you will give you a great year-end payroll report, right? It'll show the details per employee, but also have the totals on the last page for the company wide, so it's really easy to see everything. But depending on your accounting system, it may be in-house. And so what we're looking for is really just the total amounts paid per employee and for the company, so that we can just, again, verify that the expenses do agree between the different documents. Because your labor, it really is the most important expense for you to track, because, you know, the direct labor, you know, that's what we're using to actually, you know, calculate your rate, right? And your indirect labor, that's your biggest expense in your overhead. So you want to make sure that you're capturing all of your overhead so that you can be reimbursed as fully as possible. And you want to make sure that your rate is accurate. So you need to make sure that your direct labor amount is accurate, right? Because that direct labor, just a little difference makes a huge difference on your actual rate.
I have a question.
Okay.
So if we're working through the details and what we have some question we can't seem to resolve, is it good to just reach out to one of these?
Absolutely, yes. Please, if you have any questions when you're working on an ICR schedule, if you know, you can reach out to me or Lamin. Lamin Ceesay is our Safe Harbor program manager. So if you have any questions about Safe Harbor, he's your point of contact. On our website, we have everybody on our external team listed. So you can reach out to any one of us with any questions that you have, and we will be more than happy to answer. You know, if you need any advice on, you know, allowability of an expense or something like that, you know, we would much rather be able to kind of discuss it before you submit for your rate review, because, you know, if you think something's going to be allowed and it isn't, and it makes a big difference in your indirect cost rate, you know, it can lead to you know, a little bit of a headache, and you know, we would much rather avoid any surprises. So yeah, please feel free to reach out.
Email's best?
Email works, yeah.
I'll ask the next question. Do the same requirements for having approved FAR rates or IDC/Safe Harbor apply for alternative procurement contracts such as design build or GCCM?
I think I'm not exactly sure. If, with the design bid build, I'm not real familiar with those contracting. But I believe you're probably gonna need to have an indirect cost rate because it's gonna be federally funded.
Right, yeah, because of the federal funds. All right, online, if there's anybody else who has questions for WSDOT specifically, speak now or forever hold your peace.
Did you have?
Will this presentation be emailed to attendees as well?
Yes, all people who registered, regardless if they showed up today or not, will be emailed the presentation in PowerPoint format as well as this recording.
Perfect, thank you.
All right.
Thank you, Jaren. We appreciate you. And up next is our next presenter, Diana. Get you situated. Thank you
All
so
right,
much.
yeah, thank you. So welcome, everyone. Good to see you all here and hope you all are alive and awake and enthusiastic online. So next slide, please. So I'm Diana Strassmeier. I head up our architecture and engineering services group at Aldrich Advisors, a CPA firm in Oregon. And indirect cost rate calculations, reconciliations, auditing is kind of, that's my bag, if you will. I've been doing this for 25 years and I'm very passionate about helping businesses understand how indirect cost rates work, their structure, and how to make sure that you're complying with the laws and regulations. And so happy to answer any questions as we go, and afterwards, certainly happy to assist, and that's my contact email. So, all right, next up. So we're going to be talking about some of the same stuff that Jaren actually just mentioned. We're going to go maybe a little bit deeper, maybe from a different angle a little bit. But certainly if you have questions as you're thinking through these things, let me know and we can kind of dive in. So first we're going to talk about kind of what is the indirect cost rate, right? How is it used? And why does it matter? And so you'd actually ask the question about, do you need an indirect cost rate for other kinds of contracting? If you think about it, and we'll get into this a little bit more, but the indirect cost rate exists regardless of what kind of work you do. If you are billing for your time, you have an indirect cost rate, in which case understanding it, regardless of whomever you're working with, is really important so you can make sure that you're recovering all your expenses properly. All right, so we're also going to learn what it means to graduate then from that Safe Harbor program, Lamin's favorite space. We're going to talk about the steps to determine your indirect cost rate, and then gaining a little bit of comfort with the ante-tables here in Washington. All right, so first up, is this how you feel when you think about the indirect cost rate? Perhaps. All right, next up. Okay, so basically it's kind of a subset. Jaren mentioned the profit and loss statement. It's kind of a subset of your profit and loss statement. And so there are pieces in the profit and loss, the numerator composed of allowable indirect costs and the denominator composed of that total direct labor. Have you looked at your P&L to see if you have a line that says direct labor? If you're looking at your P&L and it doesn't say direct labor, but instead says payroll expenses, for example, or just salaries and wages, or principal time or something, in all likelihood, you're not segregating your direct versus indirect labor. And that's your first point of holy moly, I'm not ready for an indirect cost rate calculation. So really important that we know then what that direct labor is. And then because we've got a numerator denominator, we've got then a percentage, right? And it's generally presented to the nearest 100. We'll have some state and local agencies that actually get to the nearest thousands. It used to be to the nearest 10th. We're just getting deeper and deeper, so that's all good. It exists, so that's fine to do. All right, next up. All right, so as far then as the calculation, right, on the left is that kind of numerator denominator. And as far as where it comes from in the schedule, we start with the top of the schedule, as Jaren showed before, and I'll show again, is direct labor. Next up, we have our allowable fringe benefits. And you notice I didn't say allowable direct labor, just total direct labor. So it doesn't matter if it's allowable or not, because it's the denominator, all the allowable costs have to be spread against the entire denominator. So we can't bifurcate allowable and unallowable direct labor. Direct labor just is what it is. So total direct labor, allowable fringe benefits Our allowable fringe divided by direct labor is our fringe rate. Some people like to understand what their fringe benefit rate is. And then allowable overhead and operating expenses divided by direct labor is our general overhead rate. And then the sum of those two, if you will, whether it's the allowable fringe benefits, the allowable indirect costs, sum to the total indirect cost, and that gives us our total indirect cost rate divided by direct labor, right? So makes sense. Any questions on the
Where do
calculations?
payroll taxes fit into that?
Payroll taxes are typically part of fringe benefits. And you don't have to segregate FICA versus FUTA and SUTA and all the other payroll taxes we have under the sun now. You can just have payroll taxes as one grouping. I will say typically on your P&L, you might have a bunch of different accounts. And it's fine to have each of those accounts listed on your indirect cost rate schedule, but it's not required. You can actually group like accounts together. Yeah. Okay, next slide. All right, so this is a sample indirect cost rate schedule, also known as an eye test for those of you in the back row. And even actually me up, mid row probably, that's really tiny. Okay, so in this sample schedule, we've got our direct labor sitting at the top. And then the next section, if you will, is those fringe benefits section. Couple things I'll say about that. One is you'll see bonuses are listed up here on the first line of fringe benefits, not required to be segregated. Bonuses are actually, they can be part of indirect labor as far as groupings go or separated on fringe. It doesn't matter. I will say some companies don't like to separate them because indirect cost rate schedules might go to primes or others that they don't necessarily want to see how much they're paying in bonuses. So as long as WSDOT can see it, or the DOT that you're working with can actually see those bonuses when they get your backup data, that's okay. All right, health insurance, paid time off, payroll taxes, retirement plan contributions, the employer portion, right? Because it's the expense, the profit and loss piece. Typically, sometimes training and education is either up here in fringes or it's down below in overhead. Workers' comp insurance is typically up here, and then sometimes there are other fringes that are just kind of grouped together. Any questions about fringe benefits? And if you're thinking about your chart of accounts, sometimes like if I'm using QuickBooks, for example, and I'm not recommending or saying you can't use it, but if, for example, you're using that, sometimes it's nice to have a parent account called fringe benefits, if you will, and then the second tier of accounts for each of those different kinds of fringe benefits, and it lets you nest accounts within other accounts so that you can then see, okay, well, what are my total fringe benefits, right? That's kind of one of the pluses of having different levels of accounts. All right, so then we've got our fringe rate calculation in this example, 58.18%. All right, next up is general overhead. And so in the general overhead section, this is all of the other expenses in your P&L, except for, it doesn't include direct costs, right? Direct costs are not part of this equation, which is to say we have to make sure that our chart of accounts separates, as Jaren said, separates those direct expenses. So just our overhead expenses. And then you might also notice, depending on your accounting system might segregate a couple other kinds of expenses out of your typical profit and loss. They'll be like in your other income and loss section. And so one of those expenses is interest expense. Interest expense is still an expense, so you want to include it here because it exists. However, it's not allowable. So you're going to pull it in and then you're going to back it out. But just to be aware, you really want to look at your entire P&L and make sure you're picking up all the appropriate things you need to pick up. I will say I've had a few clients that anyone have this in their P&L or a previous company's P&L, miscellaneous income? Yeah, so that's an account you have to be really careful about because that could be a refund of an expense. And if it's a refund of an expense, it goes as a reduction of that expense on this overhead statement. So I've had clients where they've gotten workers' comp audit refunds, for example. That's a reduction of your workers' comp expense. So that goes there. And so the total general overhead calculated and then plus fringe expenses are total indirect cost to then give us our total overhead rate. Mine's a little higher than yours. I don't know, so sorry about that. And then just a little note here, FCCM. stands for Facilities Capital Cost of Money. And this is basically, it's its own separate calculation, still divided by direct labor. It usually ends up being like less than 0.5%. I mean, it's a pretty small number. However, if you have a lot of assets, fixed assets, computers, buildings, land, whatever that you're using for the business, it might be worthwhile calculating the facilities capital cost of money to make sure that you're getting reimbursed for it, because the only way to get reimbursed for facilities capital cost of money is to request it. So it has to be listed in your indirect cost rate schedule to actually get reimbursed for it. And it essentially, if you'll think about it, it's kind of like the government recognizes that it costs money for you to have purchased assets. And so because you had to expend money, you're paying interest on what you spent the money on all these assets that you're using on government contracts, but interest is unallowable. And so this is kind of their nod to, okay, well, we get it. Like you did spend money here and there's a little bit of a recovery. And if you may recall, a couple of years ago, do you guys remember what the interest rate was back in the day, right? When we were like, oh my God, it's like good old days, super low, that's awesome. Yeah, not so much anymore. And so it uses the US Treasury rate, the 6 month average rate. And then the two, if you will, because this is an annual schedule, 2 sets of 6 months, average, get our rate that we use. Do you guys have an FCCM calculation on? I think you do, yeah. So you can use, certainly WSDOT has that calculation on their website. Might be worthwhile for you, certainly if you don't have a lot of fixed assets. Probably not worthwhile. All right, next up. Okay, so how is the indirect cost rate used, right? So I mentioned before that regardless of your customer, if you are selling time, you have an indirect cost rate. And so when we think about that, the purpose is really to make sure that you are covering the allowable costs incurred, because you're only covering allowable costs, right? You're not covering all of your costs based on the indirect cost rate. And that they're allocated appropriately or equitably among all direct labor. Okay, so certainly we want to make sure we're recovering all of our costs. And the other piece to know is if you have a massive amount of unallowable costs, that's coming off your bottom line. So understanding what your unallowable costs are and why they're unallowable, and if potentially they're avoidable, is going to help you actually not have as much lost profit. So really important to know what's allowable, what's unallowable. Certainly for estimating, right? If we don't know what our costs are and we don't know what our rate is, then when we're trying to estimate to bid on a project, we're not really going to know how much we need to have in our estimate. And definitely used in billing so that we're invoicing for and being reimbursed all of our allowable costs. And then to evaluate the effective, has anyone heard of effective multiplier or actual multiplier? And you might hear this and be like, what in the world are y'all talking about? Well, I'll go through an example of what that multiplier means and how we're kind of measuring it and why it matters. So any questions before we move along? Y'all good online? Awake? Are they all paying attention online?
I hope so.
Cameras everywhere, right? Okay, all right, next up. Okay, so this is an example of an estimate. And so in this example, we're basically saying, all right, we're expecting it's going to take however many hours for each of our engineer levels and project managers, and that's their pay rate. And so we're calculating out, all right, this is our raw dollars, 385,000 in this example. And then in our example here, we've got an overhead rate of 146.45%. So our total costs are about almost $1 million. And then we want to make profit. WSDOT's really nice. They allow 30% profit, or depends on the project, but it's not on the overhead rate, right? It's on the direct labor. So 10% profit ends up kind of equating to 30% profit if you have a low overhead rate. That might not make a whole lot of sense to you, but just recognize this is typically how a cost plus overhead schedule is billed, or estimate is created, but typically billed as well. And then you might get reimbursed other direct costs, which is just straight reimbursement, right? There's no profit or anything on that. And so we think it's gonna cost us about $1,048,000. And so our actual multiplier in this case is C, which is the estimate, minus the other direct cost travel, right? So basically the total reimbursable costs, except for the stuff that's just a straight pass through, divided by our total labor. So what am I gonna be able to bill for this? Divided by my direct labor. And that's what I'm expecting my multiplier to be. And so in this example, 2.71 is the multiplier. And so when you then do your billing, you can actually see, is this where my multiplier is? Is this where I'm ending up? And if it's not, if it's lower than that, what do you think? Is that a good thing or a bad thing?
Not good.
It's not good. Yeah, it's a bad thing. So if our actual multiplier, when we start billing on this project, ends up being less than 2.71, we're probably gonna be losing money. So, okay, all right. So that's kind of how the estimate example works. Yes.
Just a quick question, and this
Sure.
might be a very silly goose question, but the overhead rate percentage that you have there, like 146.45%.
Yes.
What, so my curiosity is just, what's a good percentage? Like why did, you know what I mean? Like,
So your rate is your rate. Your
Okay.
overhead rate is your overhead rate. Overhead rate's the same thing as indirect cost rate. Okay. What I will say is typically I see lower overhead rates for inspection, survey work. Basically where there's not required to be a lot of overhead costs to
Yeah.
support that, and the typical utilization tends to be higher. And so that tends to drive down, utilization drives down the overhead rate.
I see.
Typically my design professionals, they typically tend to have a higher overhead rate because there's just more stuff, right?
Yeah.
They're in the office, so they've got this probably significant occupancy cost, and they're not out and about traveling on project stuff, but they might be on bids or, proposals or training, all those things. So it really depends. What I would say is it's important to understand what your optimal overhead rate is. And by optimal, I mean, what can you survive at? Like what makes sense so you can keep your employees and so that you can give them the fringe benefits that's appropriate for them to receive and take care of your people and pay for the things that you need to pay for. And then what's that direct labor number gonna be? Anticipated, right? So there's a lot of forecasting involved, right? How many jobs do I think I'm gonna have over this year, over the next 18 months? What's my backlog of projects and what kind of labor dollars and hours is that gonna take? So now I've got my expected labor dollars and hours. I know what my expected overhead rate's gonna be, or my overhead cost is gonna be, and then that's gonna give me my overhead rate, right? And so it may be that, that as you go along, you might actually, like your true overhead rate might be 125%. That's okay. The big thing though is you want to make sure that you control it pretty tight against that 125 or whatever that number is, because the big problem that companies run into is when their overhead rate is a big roller coaster, the ability to actually get reimbursed all of your costs is delayed, right? Because now I'm operating at this really high rate, but when I submitted, I had a low rate. And so now I'm gonna submit, it's gonna be high. I might get a little bit of flack for having a high rate. And so, but next year, when I submit my rate, okay, they're gonna approve it. Hopefully everything's correct. You've got that higher rate, and now your overhead rate is much lower because you've got a lot of people working, right? But meanwhile, that year when you were actually experiencing a super high rate, you were getting paid at a low rate, a low overhead rate. So you might have had cash flow problems, right? Yeah, so that's why it's really, your goal is really to kind of find that sweet spot of where your overhead rate needs to be so that you can maintain it as much as possible. I know that's a big ask in a lot of cases, right? Because sometimes you're like, okay, I gotta ramp up and hire all these people and now I'm gonna wait because this contract didn't start yet or whatever. So I get that. That can definitely be a strain on resources for sure. And quite frankly, when you're in the safe harbor program is the time to make sure that you can get to, you know, okay, what is my rate now, right? If I'm in safe harbor, am I way high and should I stay in safe harbor? Do I know that I'm way high, right? Gotta make sure that we know. And I have a limit for how long I can stay in safe harbor, right? Optimally, 3 years is the goal. We don't want to be extending and extending because you need to be able to get out of that safe harbor program. But we need to know kind of where our rate is and what are we missing? So maybe your rate's 120 and oh my gosh, I don't offer a retirement plan to my people. I'm not going to be able to get more people and I'm already at 120%. So it offers you this opportunity to kind of learn to see where is my rate, where is my optimal rate, so that right when you start and submit for safe harbor, you want to be diving into what does it mean? Where's my rate? Where's my optimal rate? So that I can make sure that when I'm ready to graduate from safe harbor, I'm not losing money, right? Yeah, okay. Any other questions here? Okay, next up. All right, so this is just a sample invoice, not typically right with WSDOT because you guys are using anti-tables, but if you just think about the baseline is, and it still works the same, right? Susie Smith, Susie is my favorite employee, you might see her again. She makes $100 an hour, she works 50 hours on a project. I paid Susie $5,000. I better see that $5,000 in my P&L for Susie under this project. I'm gonna bill her overhead rate and then profit in this case, and then the total invoice. So in this case, my net profit that I'm making on Susie for this time is $1,200. If I have interest expense of $5,000, I'm losing money, right? So it's really important that we know what the allowable stuff is that can be captured in that overhead rate so that we make sure that we're not ending up in the red, if you will, that we're losing money, okay? All right, so that's a billing example. Any questions? Okay, next up. All right, you guys ready? You're graduating from the Safe Harbor program? Yeah, it's all good. Feeling fine. Okay, next up. All right, so Jaron mentioned that there are a couple options after you submit or after you graduate from Safe Harbor. Certainly the self-submitted ICR, making sure that you're able to self-submit, right? That you're not over that $1 million threshold. But you calculate your indirect cost rate without an external audit. Not required unless you're over their threshold. It really works well for small businesses or those with less complexity. You know, why get an audit? Why put yourselves through that pain and suffering if you don't have to? As an auditor, I can say it's work, you know, so optimal if it's allowed, if you're under that threshold. Pros, certainly it's cost effective, right? Timely, simplified process. The con though being that you've got potentially increased risk that you're either not picking up unallowables and that is going to add more scrutiny and more time to getting it approved. Or maybe you disallowed something that's allowable and you don't necessarily know that. And so when you submit, you don't necessarily have exactly the right rate. And then certainly, if you're not calculating direct labor, you don't have a rate because you need to be able to calculate direct labor to calculate your rate. All right, and then in the externally audited ICR, this is where you calculate your indirect cost rate audit, or you calculate your indirect cost rate, and then the auditor comes in and audits that rate. And I will tell you what an audit means in just a moment. It's best for larger businesses or those with more complexity. Again, may be required if you're over that threshold. The pros being that you've got more credibility, right? Because you've got third-party oversight, you've got someone else looking at your books. So there's reduced risk then from the DOT standpoint, because they've got then somebody who has no horse in the race, if you will, looking at the rate to make sure it's correct. Certainly the cons being it's expensive, higher cost, and it's time consuming because it's not like you can just say, okay, here are my books, go ahead and audit, let me know how it went. If that's what happens, that is not an audit. because the auditor is required to test the transactions, they're required to interview. So you're having to then pull the transaction back up, the receipts, the invoices, timesheets, payroll reports, all the things, your policies and procedures. All that information needs to then be provided to the auditor for them to be able to audit. So those are your options once you graduate the Safe Harbor program. Might seem a little overwhelming, but I will say if you're under that threshold, that when you're in the Safe Harbor program is the time to get your ducks in a row. Ask all the questions, get all that information, get some sample templates, make sure that you've got reasonable policies, that you're following those policies, have an employee benefit manual, know what you can afford to pay for your employees. All right. Any questions about that? All silent on the Zoom front, huh?
Yeah.
Okay, all right, people. Hope you're awake in there. Okay, so as far as the submission process, and Jaren went into this a little bit, but I'll go into it a little bit more. That indirect cost rate in Excel, they'd like it in Excel so they can recalculate. Makes it a lot easier to make sure the numbers calculate instead of a PDF when they're having to. Do you guys still have 10 keys? No?
No.
Calculators? No.
Not anymore.
Okay, so yeah, so Excel, please. Provide those financial statements, the balance sheet, profit and loss, also known as the income statement. You might be wondering why the balance sheet. Are you wondering why the balance sheet? Yeah, maybe you're not. Good, all right. And the balance sheet is because we want to see, and they want to see, what's on your balance sheet, right? Certainly cash, let's hope. Receivables, maybe fixed assets, but you might have some prepaid expenses, you might have some accrued expenses. And so those things, or accrued paid time off, accrued vacation, accrued salaries, those things would actually impact your P&L, especially if they're wrong, right? So making sure then that the balance sheet has the appropriate balances on there, that we don't see like a debit balance in your accrued expense account, which would be a liability, and if there's a debit balance, that's a problem. And if what I'm saying doesn't make sense, then we definitely need some understanding about how all that works. So I would definitely reach out to WSDOT and get some help and some advice and potentially bookkeeping help to make sure that somebody understands what needs to be done. But if we're seeing balances that don't make sense, that are not the natural side of the equation, then it causes us to question, why is that there? What happened to create that balance? And so and potentially it could impact the overhead rate or the indirect cost rate. Yeah,
Are you gonna talk a little bit more about what to look out for in a bookkeeper?
sure. I can talk about that right now.
Okay, yeah, cause if I wanna, can I just call any old bookkeeper to help me out with this? Cause if I'm a
You
business owner
can,
and
but
I don't
you-
understand it.
Be frustrated.
Yeah.
Just call any old bookkeeper.
Okay.
It might be a good young bookkeeper that you want, I'm just kidding. So when it comes to having somebody help you with your books, a bookkeeper and or a CPA, the real question is, do they understand job costing, cost accounting? So that they can say, when you say, I'm traveling on this project, and they say, okay, I'll just book that to travel. It's like, no, I'm traveling on this project. So job costing would say, I need to cost it to that project, right? Same thing with labor. I'm working on this project. Okay, well, now I need to make sure that my labor hours are translated to labor dollars hitting that project. And so if they don't understand that, if they just done bookkeeping for retail or manufacturing or a business that doesn't sell time, essentially, they might not know job costing. And so that's a crucial component. They have to know job costing. And it can be learned, but it is important. And the accounting system has to be able to support job costing. There are some accounting systems, if you get like a Simple Start QuickBooks, for example, they don't do job costing. So that's not going to work. So the accounting system has to support it as well. And then the bookkeeper also, you'll want to make sure that they understand the FAR. So if you say, so what kind of experience do you have with the FAR? And they say, you mean like the comic, the FAR side? No. Or if they say, how far? You'll be like, goodbye, thank you. How far did you travel? Yeah. Okay, so it's really important that they understand job costing the FAR. So those are some interview questions. And then what kind of experience do you have in working with architects or engineers working on government projects? Now, maybe they don't have any experience, but they're super smart and they can figure it out. Okay, well, then they need to get some training so that you can get comfortable with them, right? So whether it's a bookkeeper or your CPA, if you're gonna have your CPA help you with your indirect cost rate schedule, you wanna make sure that they understand what that means, what that entails. Point them to WSDOT's website. I mean, your state has like the best, from what I've seen, training of any of the states that I work with, and I work with a lot of them. So I would definitely recommend, if your CPA is not familiar with it, but you love your CPA, because usually we love our CPAs, get them to get some training on it. So, all right. Any other questions about that so far? Okay, all right. So provide payroll reports. So I have 941s here. Does everyone know what a 941 is? That's your quarterly payroll report that gets submitted. And the year-end payroll register by employee. Here's our problem with the 941 report. The 941 reports federal wages. Actually, it reports federal withholding, maybe federal wages, Social Security wages and Medicare wages. But it might not, if you have like a Section 125 plan, right? If you offer medical insurance that an employee can pay for, that number is not going to be in there. So your 941 does not necessarily reconcile and tie to your labor dollars. Just be aware of that as a potential limitation of your 941 report. But whomever you use, whether it's your internal payroll provider, Gusto, QuickBooks, Intuit, ADP, Paychex, whomever, there is a year-end payroll register, payroll master control, payroll summary that is going to provide you the full gross compensation of your employees. And like Jaren said, just make sure that it doesn't, I've seen a few reports that have come from payroll providers and they're like, okay, gross compensation includes this reimbursable expense. And I'm like, is that compensation? No, reimbursable expenses are just a reimbursement of an expense that an employee incurred. And so you want to make sure that you understand what are all the components of those payroll reports. And if you don't know, ask your payroll provider, because they should be able to tell you exactly what's in there. Yeah, question.
Question online says it says only 941, not the OQ or 132 or other state quarterly PR reports.
No, I wouldn't bother with any of those state reports, because they're just reporting what is taxable under their scenario. So it could be that certain kinds of expenses, reimbursements, I should say, certain kinds of deductions may or may not be included in that payroll report. So you really want that report that is your gross compensation report, and to understand what is included in that payroll provider's gross compensation calculation so that you're pulling the right things, okay? And it's pretty, if you think about just regular payroll, right? When we're running payroll, if we pay people by the hour, right? If we pay them, I was gonna say $10 an hour, but that would be illegal, right? So pay them $100 an hour and they worked 40 hours that week, $4,000 is their gross comp, unless I didn't do my math right, which is possible, but that's their number, right? $4,000. So that's what we should see then in that payroll report. If we see $3,850, where'd that $150 go? What is that? Where did that amount go? And so really understanding and asking your payroll provider to explain it to you. Totally, I mean, you're paying for the service, right? So ask. All right. Labor distribution detail report. This is the one that gets everybody, because they're like, yeah, here's my timesheets. Here's my timesheet report, right? I can run this report from my system. It tells me all the time that all the people worked and here are the things. And I'm like, okay, so where are the dollars that are attached to all those hours? That's what I see the most of small businesses is they do have timekeeping. They use, a timekeeping software, but that's not connected to the accounting system to cost out those labor hours. So really important that you have a system that actually allows you to translate those labor hours into labor dollars in your accounting system in the proper buckets. Does that make sense? Yeah, so that's what I see the most, especially if it's like a QuickBooks setup. If you're just using the default setup, it does not break out labor by category. It does not break out direct versus indirect and holiday and PTO from a cost perspective. It might from an hours perspective, but not from a cost perspective. So you do have to get in there and get some details and actually have it set up properly to do that. Make sure the reports, this is like huge, make sure the reports that you have reconcile to the financial statements. And provide reconciling schedules where they might not tie. So for example, what I mean by that is, so Jaren was mentioning labor reconciliation, right? They're gonna look at your payroll report, see gross comp, look at the P&L and say, okay, do those two agree? They might not agree. And it would be okay, because you might have accrued payroll. You might have this liability, right? Beginning of the year, I owed a week's worth of labor, end of the year, I owe 2 weeks worth of labor, whatever. And so that liability needs to be reconciled to payroll to make it agree. So reconciliation schedules where those two amounts do not tie. And if you don't know what that means or how that works, I don't know if you guys have a reconciliation schedule.
We have an example on the
Okay.
website.
Yeah, so certainly look at that and chat with your CPA. They usually know kind of how those things work, or your bookkeeper. A certificate of your indirect cost rate. So that's Federal Highway 4470 form. Do you guys require that with the submission, I think?
Yeah.
We got that from your website. So, okay, yeah, it's required with submission. Basically that Federal Highway 4470 form is saying, I certify that this is my indirect cost rate, that I, as far as I know, have only included allowable costs, that this is my accurate direct labor. This is my accurate allowable indirect cost rate. Okay, the responsibility for that is not your CPA. It is not your bookkeeper. It is on the owner, the business owner. And then they have an information sheet, and that basically just gives them a little bit of information about you, so that they can understand kind of what your risk profile is, essentially. It's really important, and the states were tasked years ago, because the feds came down and said, not to WSDOT, but to other states, hey, we're not confident that you are actually overseeing your subconsultants or your primes or whoever, because the data that's coming to us as the feds is not accurate, or it's not reliable. And so you states, all the states have to develop a risk management system, risk profiling, so that you can understand where your risks are, what companies are most risky or less risky, and how you're going to mitigate that risk. And so the information sheet for them helps them to get started on that path of how much do we have in contracts with them? How long have they been in business? You know, all the things that would tell them they either do know what they're doing, or they perhaps might be less experienced with what they know. So
I'm
yeah.
assuming there's a information sheet example on WSDOT?
The form is on our website. Yeah.
Fantastic.
Yep, okay. All right, next up. Okay, so insofar as that self-submission process, they might ask additional information, as Jaren said. They might ask for copies of payroll records or timesheets and all those things to make sure that they're confident that that rate is accurate. Again, they're not providing assurance as to the accuracy of the rate, but they need to get confident and comfortable that that rate is accurate. And we consult and other CPAs, you can work with them as well, your CPA, to ask them to make sure and help you work through your rate, so that when you, management companies, submit your rate to the agency, you feel comfortable that, okay, this looks good to me, right? So lots of examples and forms, as Jaren mentioned. The submission still, right? Consultant rates at WSDOT. Okay, good. And then you may need to provide CDQ or an ICQ. CDQ is a cost disclosure questionnaire. Is that right?
Right, so WSDOT has a cost disclosure questionnaire, which is a truncated version of the AASHTO internal control questionnaire. We don't necessarily require the CDQ every time. It might be like every 2 or 3 submissions, we might ask for an updated version. So we can just kind of, keep our risk assessment up to date.
Yeah, and I will say, provide that to your bookkeeper and or your CPA, so that they can see what you filled out, maybe help you fill it out, and make sure that it's accurate. Because I know when I work with clients, I always say, okay, can you provide me your ICQ and they're always like, what are you talking about? All right, let me back up. Internal control questionnaire. But I will say it's just helpful. It's helpful for all of us as the people who look at the rates to understand what's going on with the business. And then you might also need to provide a compensation analysis. So be prepared for that. And all that information is on their website. So there you go. Still some screenshots from your website. Thank you. All right, next up. All right. Really important, ensure there are no arithmetic errors on your schedule. That's like, I don't know, would you say like the moment you come across an arithmetic error, you're like, okay, all
This
right.
person knows what they're doing.
Yeah, could be a problem. So definitely double check. Sometimes we have hidden rows or whatever, just make sure that the schedule works. You're not hiding anything or, inadvertently have a row disappear. Written policies for expenses, receipt requirements, approval, billing, unallowable costs. Having written policies is like huge because then you know what to go to when you're like, okay, how do I deal with this again? Or you've just hired someone and you're like, all right, so make sure you submit your time. And they're like, I don't know what you're talking about. Well, you have a policy and so it's written and they can look at it. Really helpful to do. And quite frankly, I mean, almost table stakes, like it needs to be done, because if it's not, then people are gonna do things differently, right? All right, having supporting documentation for your expenses is also like a given. If you incur an expense, there should be support for it. Optimally, maybe not even optimally, maybe just given, it should be like filed in a place that is easily found. So if it's electronic, having a filing system really works. Those of us who love organization back in the day, right, when we used to organize our stuff when we were little, it fulfills that excitement that we might have about that. But it just helps so much, right? Because whether it's the DOT or an auditor is asking for stuff, I mean, come on, like, let's not take forever to find it, right? So it's helpful to have it all organized, which maybe just seems like a given. I don't know, but I will say I've had concerns about that. Approval, and you might say, well, I incurred it, so obviously I approved it. It's really helpful to have a formal process for approval, even if it's just a two-person shop or something. Even if it is just you, having something that clarifies that it was approved by you, whether it's a stamp or a electronic stamp or something, just so it's clear, and that it's clear what kind of expense it is, right? It's a project expense, it's not a project expense, it's a bid proposal expense, like what did we incur this for? This thing was shipped to this other location and it's my child's dorm room. That would be a big red flag. So, really helpful to make sure that we're documenting and have good support for our information. Confirming that all the items on the schedule certainly reconciles the books. That's really important. It should come directly from the books, so it should reconcile, but sometimes that needs some work. Understanding the items on the schedule, what's allowable, unallowable, removing all the costs before they are questioned. So that allowable cost column should only contain allowable costs. And so if you're not sure about something, ask the question. We're all here to help. We all support the FAR and just making sure that people are doing things correctly. Yes.
I'm just curious, can you give like a quick example of an allowable or unallowable cost?
Alcohol.
Okay.
Thirsty Thursdays.
Yeah, there's, yeah.
Is that just a federal thing or like?
It is a federal thing. It's under the FAR. FAR
not-
31-205.
Food and-
52?
Food and alcohol or just?
Maybe. Just alcohol, but food, meals, depends. So, Jared mentioned they have some like that schedule over that, a set of training documents or interpretive guidance on things that are allowable, unallowable, because there are some gray areas, right? So you just mentioned
Yeah.
food.
Yeah.
Well, it depends, right? If you're traveling, it's limited to federal travel regulation limits for meals. If you're not traveling, then it's limited to reasonableness, and there's gotta be a business purpose and who attended and all the things that support why you needed to incur this meal cost, right? So really the business purpose being huge. Sometimes we don't see that and we're like, okay, so this receipt from Panera,
Yeah.
what did you all incur that for, right? Well, it's for training, so. Yeah. Okay. And then certainly if you're unsure of allowability, consult with an expert. view WSDOT training videos, ask WSDOT audit team, and or read part 31 of the FAR, especially if you have insomnia. Huge cure.
Oh, yeah.
Yeah, like amazing. Okay. No, I'm kidding. I love the FAR. If the FAR people are watching. Okay. All right. Next up. All right. Just from some clarity standpoint as an auditor, I feel like I have to mention this. An audit provides reasonable assurance that the indirect cost rate is not materially misstated. Reasonable assurance, not absolute assurance. We're not looking at every single transaction. It's just not possible, quite frankly. And we're not in your heads, so we don't know exactly everything. So not absolute assurance, and the responsibility for that indirect cost rate schedule, no matter what, lies on management. So whomever audits your schedule, whoever looks over your schedule and helps you put it together, you're still responsible for it, which means you need to understand it and make sure that you're comfortable and confident with the numbers that are being presented. And ask questions. Like when I have audit clients that ask me questions, I'm like, this is awesome, because then I know like you want to get it right. So that's good. Okay, next up. Okay, so if you are doing an audit and your submission process there, you are going to provide the complete audit report, a certificate of indirect costs, same thing, that federal highways form. If you have another state approval, you'd provide that rate approval from the other state DOT, which may or may not mean anything to WSDOT. And then there's consultant information sheet as well, the internal control questionnaire, and then certainly there's potentially additional information that they may request. So once you submit get an audit, it doesn't mean like you're done, right? You went through this audit, it was painful, but you had fun because it was with me or whomever, just kidding. But nonetheless, you had an audit, it doesn't end there, right? The process continues when you have to submit that audit to WSDOT. There's more to go after that point. And it takes them time to then approve. Actually, whether it's an audit or a self-submitted, it takes time for whomever the reviewer is to approve it. So be prepared for that lag. All right, next up. And then again, forms and information. I love your site. It's so helpful. Fortunately, we don't have the PPP to deal with anymore. Holy moly, that was a nightmare. But lots of information on WSDOT's website. So be sure to check it out and see what's what and what's involved. And know that you don't necessarily need an audit, right? If you're below that threshold. I mean, you can put yourself through that experience, but you don't have to. So, okay. Yes, one does simply determine their indirect cost rate. Yeah, no, one does not do that. All right. So as far as establishing your actual indirect cost rate, and Jaren mentioned this as well, the accounting system has to be able to and be set up to properly capture your costs. I mean, huge that I have clients all the time where they're, especially in QuickBooks, they'll say, oh yeah, I coded it to the project. And I'm looking in the general ledger detail and I'm like, okay, I see where you hit the project, but it's in your G&A, in your general and administrative account, for example, of travel. That's not okay, because we don't look at the calculations that way. We're not looking in this column to see that it hit a project, but it's in this account that's a general overhead account. That won't help calculate your rate. Instead, that project cost needs to be up in your cost of sales. In QuickBooks, it's cost of goods sold, I think. That's okay. It's not like that nomenclature is not helpful because it's not like you sold a good, but nonetheless, it is a direct cost. And so the direct costs belong up in cost of sales, cost of goods sold, cost of services sold, whatever you want to call it, put it up with direct as far as a project related expense. A timekeeping system to capture time, right? That's huge. Like if we're not capturing our time accurately, Jaren's like, bye, like, please don't. So make sure that you have that timekeeping system to capture time. Optimally, an electronic timekeeping system that has controls in place, right? Individual has to sign in. It gets approved, it gets signed off on, submitted by that individual. It gets approved by somebody else. Even if it's an owner, the owner still needs approval by somebody. And you might be like, well, that's kind of silly because I'm the owner and who's gonna approve my time? Well, it could be their administrative assistant. And the reason for doing that is basically saying, I'm certifying that this time I submitted, right? So that's you signing off on your time. And not only am I certifying it, I'm willing to have somebody else look at my time and certify it too, because they've approved it. So you're putting your admin on the line if it's not accurate, right? And we wouldn't hopefully want to do that to our admin if it wasn't accurate. So it just gives you another kind of level of accountability. So it's not like it has to be someone who would know what likely the time was spent on, right? So it couldn't be like accounting approves the time for everybody and they have no clue what anyone does. That wouldn't make any sense. It's got to be the appropriate approver.
Question,
Yeah.
what if you're just a one-person firm?
Yeah, so if you're a one-person firm, then you're kind of like, that's it, it's just you. So that's okay. Yeah, I mean, obviously we have to work with it. You're not gonna hire someone to be like, hey, can you approve my time?
Split personality.
Yeah, right, yeah, so probably don't wanna go there. So yeah, so certainly in a one-person shop, yeah, you're just submitting your time. There's not really another person. Even quite frankly, if you're a third party CPA or bookkeeper, they're gonna be like, you want me to approve your time? Are you kidding me? But quite frankly, in all likelihood, you're working on projects. And so when you submit that time to be billed and invoiced, they're approving that time as they go through the invoicing process. I did have a client, I'll tell you a quick story, who large firm back in Maryland, because that's where I'm from. And I was there for like the first 20 years of my career. They had a paper timekeeping system, and their people would go out in the field and they would submit their time to the on-site supervisor at the client. And then this client, that employee came back and edited their timesheet and added some hours and then submitted it to my client to get paid. And so they got paid for more hours than they worked. And then obviously, maybe not obviously, but the client submitted billing, right? They invoiced for that time that they paid the employee for. And the client came back, it actually took about 6 months, which is not good. 6 months for the client to come back and say, they did not write the timesheet I have. I made a copy of it. It doesn't have those hours on it. It only has these hours on it. So clearly the person got fired very quickly, but nonetheless, that's why having an electronic timekeeping system is really helpful, because then you've got some kind of controls in place. And I will say, as an auditor, when I audit paper timekeeping systems, it's just a lot more cumbersome, because now I'm having to look at like the actual, each line item. When it's electronic, it's like kind of all integrated. So it takes a lot less effort to review and audit. And quite frankly, it just helps the whole process go a lot faster in every regard. But if you do have paper timesheets, please don't let people like submit them via Excel, in Excel, as Excel, and not having an actual certified, like have them do an Adobe signature, not like a font that's cursive. That's not like signature, but like an actual digital signature, so that they are actually digitally signing and keeping it from being modified. All right, yeah.
That's something that a sole proprietor can do to make sure that their timesheet is supported, because even though we wouldn't expect them to have the approval letter or signature, but we would look to see that it was contemporaneous to the time that was worked. So having that digital signature that shows when they finished that timesheet, when they signed it off as, as their complete timesheet, that really goes a long way, even for a sole proprietor.
Yeah.
What I would do is, if I did an Excel spreadsheet, I'd turn it into a PDF and then I'd do global sign.
Yeah.
Yep.
And stamp.
Perfect. Love it. Yep. Okay, so talked about accounting system, timekeeping system, job costing system, kind of related really to the accounting system, but we want to make sure that we're able to do job costing, to capture those project costs. And the timekeeping system, again, keeps track of the time, but not necessarily the dollars associated with that time. Actually, in most cases it doesn't. And so being able, the job costing is going to translate those labor hours to the labor dollars. Okay. And it's really important if the systems that translate the labor dollars to the labor hours to the dollars are not connected with the payroll, what could you imagine could happen? So in my timekeeping system, my accounting system, I set it up, I pay Susie Q $98 an hour. Boom, I run payroll, I actually pay her $100 an hour. Well, now I've got disparate information. My accounting system saying $98 an hour, and my payroll actually paid her $100 an hour. So now I've got a reconciliation problem because the two do not agree. So I got to make sure that my job costing system translates the actual accurate labor hours to dollars. That's part of why that reconciliation is so important to do, at least. I mean, you say monthly, I actually by payroll, because if you don't do it by each payroll, you're like, what in the world is going on here, right? So, and then, yeah, really important to have that payroll system so that you can pay employees properly and to comply with laws and regulations. All right, so that's that, establishing your rate. All right, next up. So as far as then determining the indirect cost rate, step one, I've mentioned this, it's like beating a dead horse into the ground, so forgive me, but it's true. Determining your direct labor cost. That is going to tie to your P&L statement, right? That direct labor number. Determining your total indirect costs. Also, you're going to tie that to your profit and loss statement by your line or grouping of accounts. Determining those unallowable indirect costs. And so this is where it might seem a little complicated because when you looked at that indirect cost rate calculation, you saw a column, right? That was total costs, and then another column that was unallowable, and a third column, total allowable, right? That second column, there are some accounts that are just unallowable, like interest expense, but there are other accounts where there's a portion that might be allowable and a portion that's not allowable. Optimally, you have two separate accounts like meals allowable, meals unallowable. That's kind of best practice is what you'd want to have. But if you don't have those two accounts, you could have a portion of one account that's allowable and a portion that's unallowable. Okay, so just be aware that can exist in a chart of accounts, but I would say optimally you want to be able to segregate. But there are some things like travel, airfare is lowest available fare, non-circuitous routing during normal business hours. Good luck capturing that information, but having a policy in place to do that helps you. But that is to say that if you have your person got a first class ticket and that's not the number, right? It was limited to say $500 for the round trip ticket instead of the $7,000 that they paid. That difference, the $6,500, you might say, well, it's in travel. Yeah, optimally though, we want to have this travel unallowable. So we have two line items where we code that expense, right? $500 travel allowable, $6,500 unallowable. And stop spending all of my money on first class travel, right? Okay, so using FAR Part 31 to learn what is and what is not allowable. FAR Part 31, it's not just these are all unallowable costs. It's actually like, here are some things that are allowable and here are some things that are unallowable, and it's not an all-inclusive list. So if you're looking at FAR Part 31, you incurred a business expense, it was valid business purpose, reasonable, not project specific, you might not see it in FAR Part 31. So you have to go to the first part of FAR Part 31 talks about reasonableness, allocability, what really makes a cost allowable as an overhead cost. So if you incurred it in the ordinary process of business, and it was ordinary and necessary, and anyone in a like and similar circumstance would have incurred that cost, unless FAR Part 31 says it's not allowable, it's probably allowable, right? But it's gotta make sense. It's gotta kind of fit the whole, is it allocable to the business this year, right? Like I'm not paying something from 5 years ago and I'm like, hey, forgot to pay this bill. Can't do that. All right, so FAR Part 31, nice guidelines, again, cure for insomnia and good information. So coffee is helpful. Subtract those unallowable costs from the total indirect costs to get your allowable indirect cost amount, and then dividing that total allowable by your total direct labor to get your rate. All right, next up. Visualizing the steps. All right, so again, direct labor, we have that. Our total indirect costs are 1,838,000. So this is looking at a P&L. Okay, and in looking at this P&L, you're like, wait, that's a little weird. I've got revenues in there, blah, blah, blah. Yeah, this is the P&L, and so we're taking it P&L to indirect cost rate. In our P&L, we've got direct labor, yay, love that, thank you. Total operating expenses, and then we've also got this like interest expense down here, and it's a credit, it's like weird looking, it's a negative. But interest expense, I mean, it's actually like reducing your income, right? So that's a $15,000 expense. So we add this 1818 plus the 15,000 to get our total indirect costs of 1,838,000. Eye test, can you all see that back there? No, sorry. You'll get a copy of the slides, okay. And then, and the provision for income taxes, sorry, I missed the provision. So you're gonna include that as well as part of your indirect costs. And then we gotta get rid of our unallowables. We don't necessarily see that broken out on here, but trust me, those are the unallowables. So when we do our actual indirect cost rate schedule, we're gonna have that column for the unallowables. Bringing me to total allowable indirect cost of 1.611. And then that's our indirect cost rate, okay? So you can see here though, my net income is $48,000 on $3 million of income. That's not 10%, right? Like if my profit was supposed to be 10%, why is it not 10%? You guys on Zoom, you totally know this, I know. Duh. Because we have all these unallowable costs that we're not getting reimbursed for, right? $227,000 worth of costs that are unallowable, which means they are not getting reimbursed. So that's another, kind of drives home that point of, oh, that's not a big margin. So you got to make sure you understand what's unallowable, what you can avoid as unallowable costs, so that you can reduce that differential. All right, so that's the steps. Everyone feeling good about that? Excited? Ready to go? Awake? Okay.
Ready to hire a CPA.
Okay, next up. Okay, so things that impact the indirect cost rate, I think it's really important to know kind of, oh, my rate is going way up or way down or whatever. Utilization, when you think about that, right, that's the proportion of total direct labor to total labor. So higher direct labor is higher utilization, which is going to drive the rate down. Not a bad thing, but it is the most impactful item that will impact the indirect cost rate. So if you're like, my expenses are pretty much the same, why is my rate in the way down? Yeah, well, your utilization went up. That's why the rate's down. Your expenses didn't really change, right? So utilization, biggest driver of the indirect cost rate. So really understanding kind of, I mean, it's great to have high utilization, except that maybe you're burning out your people, and then, now it's like this short-term win for a long-term loss because I have high utilization, I'm burning out my people, and my rate's really low, which means my rate next year is probably gonna go through the roof because everyone's gonna be sick and nobody's gonna be able to work, so. Right. Okay, so utilization, big impact. Fringes offered. So I made a comment before about understanding kind of what fringes you're offering, and whether that enables you to retain employees and what that does to your rate. Certainly less fringes, lower indirect cost rate. Fixed expenses, if your expenses are less, so, you'd mentioned, Julie, about like what's a normal, is 146.45 a good number? It depends, right? So occupancy is another large expense typically. If you don't have occupancy costs, right? If people are just all remote and working from home, which is great, love that. But it is gonna then reduce your overhead rate so that it's not a apples to apples situation. You can't look at your rate and say, oh, mine's 150 and yours is 130, so I'm better or worse than yours. It's just not, right? It's all about what your rate is and what your rate's doing. And then, as we mentioned before in the impact to our bottom line, unallowable expenses, the more equals lower indirect cost rate and comes out of your profit, right? Okay, so not only is it a question of unallowable expenses like interest expenses, which perhaps is unavoidable, but maybe I don't have supported expenses, so now I can't claim it. It would have been allowable, but I got an audit because I had to, and they didn't allow it because I didn't have support for it. And now it's unallowable. but it could have been allowable if I'd had support for it. So, so really important to make sure that we're aware of what's going on with our unallowables. All right. Oh, yeah.
Yeah, thank you. The fixed expense, if that, less, you have a lower indirect. If you have higher, is that because you're doing the FCCM, you're doing the calculation?
Not necessarily. I mean, when I think about fixed expenses, it's really kind of like, what does it cost you to operate, right? And so if you just have rent and utilities or multiple office locations or your software, anyone have software expense that's going like through the roof? Yeah, thank you. Yeah, those kinds of things are just, they're just expenses. And so that's why some people might be like, you know what, I feel like my rate, it's getting a little out of control. I need to look at my fixed expenses and see, is there anything I can do? Can I renegotiate anything? Can I get a smaller space or sublease something or whatever, to be able to bring that down to reduce the overhead rate? And I will say, from WSDOT's perspective, one of the things I love, and this is not me kissing up to you, even though you know I love you, and Maryland SHA does this as well, is they have profit on direct labor, which means you're only getting reimbursed cost for cost on overhead. So there's not an incentive to have a ridiculously high overhead rate because it's not like it's gonna increase your profit. It's just reimbursing you for your costs. So, I mean, I'm sure you guys don't like to pay what you don't need to pay, but there's not an incentive when the profit is based on direct labor, like there is with some other states where if you get profit on direct labor plus overhead, it's like, hey, right? But it's a lower profit percentage, by a lot. But in this case, with WSDOT paying the 30% on direct labor, it's like, you're just getting profit on that, which is great. Yeah.
So, these calculations are all based on year end, prior year?
Prior year, yeah. So in the state and local space, it's typically, and all states are different. And I think you guys operate, but let me know if that's not the case. Most states are, and all states are, you submit your rate based on your fiscal year. So typically calendar year, right? Especially if you're a pass-through entity. So calendar year, you have to submit by 180 days after the previous year ends, so typically June 30.
Yeah.
And so you're submitting for the prior year. Once you get approval, the following invoice, you get to use the new rate, your next rate, typically.
So if you're submitting 6 months after the year end, I mean, you're way past your
Yes.
cost could be
Oh,
somewhat different,
completely.
different.
Right, which is why I was saying, like,
Yeah.
it's so important to hone in on where your rate is and kind of get it as tight as you possibly can, because when you're in that roller coaster, there's this delayed impact of getting paid. You might have a great year and then holy moly, I don't have any money and I paid out a bunch of bonuses or whatever.
And then you recertify once a year?
Yes. Yep. Now, there are some states that go retroactive to the beginning of the year, the beginning of the current year. Again, you're still delayed, right? So right now, they just submitted their 23 rate. They now have to go back and redo all their invoices from January forward using 23's rate, but we're still in 24's expenses. So those could be different. And then the
You say that
feds,
Washington does that?
no,
They're based on whatever it's certified?
you guys do it based on when it's approved, right? So the following invoice.
So typically you'll start using the new rate on July 1st.
Oh, okay. So regardless of whether you've approved it.
Yeah, so the rates typically, they're on a calendar year, so they get it approved, and then the new rate is effective July 1st. And so we also have a pre-qual list, and that gets renewed every July 1st. So typically that's when they start using the new rates.
Yeah, and then other states typically it's the month after the rate is approved.
Different states have different rules.
Yeah. Yep, and then the feds you have to keep your rate on an ongoing basis and reestimate your rate. And so you're always using whatever your current rate is, which is just, very complicated.
We do have some contracts that are cost plus fixed fee where you go back. So once your 2023 rate is approved, then you would go back to your invoices in 2023 and true those up. But that's only on certain agreements. So people should just be aware of what their contract language states.
Okay, that's helpful.
Yeah, definitely look at your contracts for sure, because depending on the agency, could be different.
Well,
in
it sounds
one
like you could be using a
agency.
23 rate in 24, But you get to the end of the next year, you figure out what your new rate is, then you can go back depending on.
Yeah, depending on the agreements,
Yeah,
our task order negotiated hourly agreements do not have that true up. You just keep using the previous year, right? But the cost plus fixed fee agreements do have that true up, so you go back and, if a firm's rate is fluctuating, it might be helpful for them to be able to go and true up, but.
but it's not optional. If you true up, you
Right.
true up. So that means if your rate went down, you were paying back that difference.
Right, and we don't have, I don't think we have a lot of those contracts out there, but there are some out there.
Yeah, and there are other states that have that situation, and I have some clients who have like an accrual on their books for the differential in their rate that they owe back to the state, so, yeah. Good question.
Someone online had asked, just for clarification, so once your ICR is approved, do you need to get it reapproved every year, correct?
It's an annual update.
Annual update, okay.
And I should add, so when firms graduate from Safe Harbor, they can use that approved rate right away, no matter what time of year they graduate. So if they don't have to wait for the July 1st. They can,
And Safe Harbor was 3 years. You could be in Safe Harbor for 3 years. Then
Yeah, so-
then you use 120%.
right, it's 120% home rate and a 90% field rate.
All right, okay, keep on going. All right, so as far as supporting your rate goes, again, that chart of accounts to segregate your direct versus indirect, determination of allowability, sufficient support as evidence, receipts, approvals, a documented business purpose, internal controls on your systems. I didn't mention that before, but if you think about it, given all the things that have been going on, makes you want to go back to farming as a full-time lifestyle. But now that we are where we are, yes, having controls over your systems is huge, huge. Okay. All right, next up. All right, so why is it important? I feel like we're good on why it's important, but I'll just reiterate. So certainly from a making business decisions standpoint, knowing your rate is huge, being able to cover your costs and being able to estimate your projects going forward. Okay. All right. I'm just kidding, okay. What do anti-tables and New Year's resolutions have in common? Everybody loves them, but nobody sticks to them, but that's a joke. Yeah, so anti-tables. What do anti-tables, does everyone know what anti-tables are? What the term stands for? So anti is the actual not to exceed, often referred to simply as the ante or anti-tables. They're used for cost, I pulled this right from you guys' websites. Let me know if I said anything wrong here. Used for cost estimation and budgeting for transportation projects, establishes the allowable billing rates for primes and for subs. So Jaren showed you the example of the calculation of the anti-table for that one level, and I'm going to show you it again, and we'll kind of go through it a little bit more. It is actually used with Safe Harbor so that you can come up with what is my billing rate using that 120 or 90%. And then they have this fabulous PDF on WSDOT's website to give you more information about anti-tables. All right, next up. So as far as the components of the anti-table, we have the job classification, the direct hourly rate. So this is actually the pay rate that we pay our employees. The indirect cost rate, so it could be Safe Harbor, it could be your actual indirect cost rate, and then the fixed fee, so that's that 30% or whatever that percent is based on the contracted work. So as far as showing you then what this means, next up, yeah.
Okay.
So it is project specific, as far as the job classifications go. It is based on budget and hours estimate is consistent across all WSDOT agreements. And any changes, if you want to add or delete during the annual period, are considered on a case-by-case basis. Let me know if I'm wrong on all this. I'm just restating your stuff.
Typically, it's updated on an annual basis when you update your indirect cost rate.
Yeah, and so Jaren actually showed these exact numbers because we pulled them from your information with their direct hourly rate. So engineer one's getting paid $45 an hour. So that's their direct hourly rate. Their indirect cost rate, they're on Safe Harbor in this example, so 120%. So A, his rate times 120 is B, $54. And then the fixed fee is also calculated based on that direct labor. So that $13.50 is $45 times 30%. And then that all-inclusive hourly billing rate not to exceed, ante-table for this engineer one is the 112.50. So that's what we're anticipating the not to exceed amount to be, which is to say, maybe you hire an engineer one who is actually getting paid $42.50 an hour. You're gonna create your number based on the 42.50 because it's actual not to exceed, right? Okay, all right, next, yeah.
So this is actually one of the biggest findings that we have when we perform our invoice audits is firms will get the ante-table approved and they think, okay, so this engineer one was approved for $45 an hour, so we can bill every engineer one at $45 an hour. They forget that the billing rate is based on actual expenses, right? So, you know, that's the big key to keep in mind is WSDOT is agreeing to pay up to that amount. But it's the stipulation is that you have to pay that person that amount. If you're paying that person less, then you have to use the lower billing rate based on what you're actually paying them.
So is that to say then if someone has a bunch of engineers one, but the highest paid person gets this one, that's okay, they don't need a new ante-table for all of the engineers, so long as
Right.
no one makes more than that 45 an hour.
Right, if you have somebody making 47, you wanna make sure you update the ante-table so you can bill their full rate. Because if you bill 47 and the ante-table says 45, if we do an invoice review or an audit and we see that, we're gonna ask for a refund. And if you're paying them 40 and you're billing at 45 and we see that, then we're gonna ask for a refund.
So what happens if an employee gets a raise in their direct labor rate during the year or they change job classification?
Yeah, that's a huge deal when that happens. It's really important to then have that conversation straight away with WSDOT. And I'll actually get into the details of that in just a moment, so bear with us. Okay, next up. Okay, so as far as then their actual labor rate, it is the starting point for negotiating the billed hourly rate up to that not to exceed for classifications. And the proposals are typically gonna estimate using average wage rates, but actuals, again, billing at the actual employee's rate. And I will get into momentarily the whole kind of what happens when something changes. But I mean, actually, quite frankly, the long and short of it is you need to talk to the DOT and give them evidence that supports why this person got a raise, right? Or why they're a new job classification so that they can then approve that rate increase.
It also, so when you're filling out that ante-table, you don't have to use the rate that you're actually paying, right? This is more based off of your business plan, so you want to have like a pay scale for each position in your firm. And so you're using the top end of the pay scale, right? So it doesn't have to be what
An actual.
right, based on actual, so that would give you a little bit of room to work if you do give somebody a cost of living increase during the year.
Yeah, so definitely keep that in mind as you're filling out your ante-tables. You might have somebody in a position, but maybe they're an inexpensive person in that position, which is wonderful. But you're expecting to hire somebody in that position and you know it's gonna end up being a little bit more. So the ante-table should really reflect what you're anticipating paying, knowing that you are only allowed to bill what you pay. Was there a question back there? You good? Okay. All right, next up. So as far as the indirect cost rate, establishment or update, so the internal audit office reviews and approves the ICR, schedule for compliance, and then depending on the payment provision of the agreement, you may update that annually. Typically, you will, again, submitting it every year. And then you submit that whole package to the consultant services office for review and approval within 180 days of the year end.
One more online question. Do you need to separate out supervisor positions, i.e. like supers or foremans? On the ante-table?
It would, so you want to have a job classification that makes it clear what you're talking about, right? So if you have engineer and you're just putting like $100 an hour, then that doesn't really give the DOT much information to see to tell if that's a reasonable rate, right? If you have engineer 1, 2, 3, and 4, And so that the DOT can see that that there's experience levels, different experience levels, that would make sense, you know, as you're talking about a higher rate, right? So you just want to make it, and you want to make sure that you're using either terms that are specific to your firm or just in kind of generalized so that people understand what we're talking about. When you get real technical on the job classifications, then it can be more difficult for the DOT to even to really understand what it is that that person's role is in the firm and what a reasonable rate would be.
A follow-up question to that would be, would there be the same for apprentice steps?
So for apprentices, you might have a separate job class because they're not, you know, because like an engineer apprentice, they wouldn't necessarily have the same experience as like an entry level. So you'd probably want to differentiate it.
Yeah, it's helpful as you kind of build out your personnel to have kind of classifications and where do they fit, and am I missing something, right, in a classification? Do I need to have engineers 1 through 5 or 1 through 3, or, you know, to be able to build that out and then provide that ante table with all those potential options so that it kind of makes sense, right? And that you can then fit somebody into a bucket so that, okay, I'm looking to hire someone in this position. Well, on my ante table, I have that listed as a $45 an hour position. So is that what I'm looking for, right? Or am I looking for a higher level? In which case, do I have an ante table item that is going to support that, or do I need to request it to be added or something? So, okay. And then the fixed fee is typically negotiated. Again, it is a % of direct labor. In WSDOT's case, not with every state, but in their case it is. It's generally set, that percentage, the profit for the life of the agreement. The fee percentage is determined using a weighted guideline. So there's something they have published that gives them what that is. And then if you want to see Appendix AA of the Consultant Services Manual, you can determine how that fixed fee is established, typically based on what risk and.
Yeah, complexity of the
Complexity and-
project, essentially, it can range between 17% and 30%, depending on the complexity. On an interstate bridge replacement project, you're probably looking at 30%.
Okay, all right. And then as far as the table updates, again, if you update, you can verify the listed job classifications. Adding classifications, as I mentioned before, we mentioned requires some support for that. And if you request an ante table increase, then they need to review various factors like prevailing wages, cost index, historical cost information to be able to discern that that's a reasonable increase. So, all right. There's some resources. And certainly we're all available to answer questions. You have our contact information, so.
We'd like to thank everybody for participating, and take care. Thank you so much for being our presenters today.